Picture yourself walking to your mailbox on an ordinary afternoon, sorting through store advertisements and household bills, when you notice an official letter from the IRS. Your heart skips a beat. You tear it open, anticipating perhaps a standard notification, but instead, you're looking at a fine $10,000, and the hardest part, you're completely unsure what mistake you made. You didn't conceal funds internationally. You didn't operate an undisclosed enterprise. You didn't falsify your tax documents. All you did was deposit some currency from your truck sale. Perhaps your daughter transferred you funds to assist with healthcare costs, or you relocated money to eventually fix that aging roof. Perfectly ordinary retirement behavior. However, in 2026, ordinary doesn't necessarily mean protected, because what's causing these fines isn't unlawful conduct, it's sequences. Sequences identified by computerized systems that don't understand your circumstances. And when that system determines something appears questionable, the fine can begin at $10,000 for one single infraction. Today, we're going to explain precisely what's occurring, why numerous retirees are being caught unprepared, and the one basic error that can transform an innocent banking visit into a governmental issue. Hello, I'm Sophia, and I dedicate my time assisting retirees safeguard the savings they worked their whole lifetime to accumulate. And I need to discuss with you something that has silently transformed in the banking world this year. The regulation itself isn't recent. Actually, it's existed for many years, but the manner it's being applied in 2026 is totally different. Quicker, computerized, and much less understanding when something doesn't align properly. My objective today isn't to frighten you. It's to ensure you comprehend what's actually happening, what type of regular banking behavior can activate a substantial fine, and critically, how to safeguard yourself so you never encounter that $10,000 shock. Because when you see how this operates, you'll understand the risk isn't apparent, and that's precisely why we must discuss it. So let's begin with the section that's catching individuals completely unprepared, the regular transactions that appear totally innocent on the outside. Imagine this. You sell your old pickup vehicle for $15,000 in currency. The purchaser arrives, counts it completely, and you drive to the bank to deposit it. Straightforward. Or perhaps your son transfers you $20,000 to help handle some unexpected healthcare bills. Or you eventually take that single sum retirement payout you've been considering for years. Or you transfer a substantial portion of savings from one account to another because you're making a payment on an RV. None of that is unlawful. None of that is questionable. It's simply reality. It's retirement. It's your funds. But here's where circumstances start to change in 2026. Banks aren't simply holding your deposits. They're documenting certain kinds of behavior automatically. And those documents don't remain in a storage cabinet somewhere gathering dust. They're being examined, categorized, and compared by systems that are built to identify discrepancies. So, when a substantial amount of currency suddenly shows up in your account, the system doesn't recognize truck sale or contribution from daughter or retirement distribution. It recognizes figures. It recognizes sequences. And if those sequences don't correspond what's on your tax documentation or other banking records, it raises a digital flag. This is the section that seems unjust to numerous retirees, because from your viewpoint, you're simply handling your finances responsibly. But from the system's viewpoint, it's questioning one very particular thing. Where did this money originate, and was it correctly documented? And if the response isn't absolutely evident in the information it has available to, that's when difficulties can begin. Now here's the surprise that amazes almost everybody. The regulation behind all of this isn't recent, not even remotely. Actually, it's existed for many years. What's transformed is how intensely, and how effectively it's being applied. At the foundation of this is something called a currency transaction report, or CTR. And regardless of how serious that sounds, it's actually very simple. By regulation, banks are obligated to submit a CTR whenever someone completes a cash transaction exceeding $10,000. That includes cash deposits, cash removals, even particular kinds of movements. So, if you enter your bank and deposit $12,000 in currency, the bank completes a document and transmits it to the government. You don't complete it. You don't even necessarily observe it. It occurs behind the counter. And here's what's significant. A CTR is not a fine. It's not a charge. It's not a signal you did something incorrect. Countless these documents are submitted every year. For many years, this has been standard. Business operators deposit currency, people sell vehicles, families transfer money around, the bank submits the document, and life continues. So, if that's been the regulation for years, why are retirees suddenly learning about $10,000 fines? Because in the past, these documents mostly simply remained there, unless a human examiner had a purpose to investigate further. Today, that's no longer the situation. Now, those CTRs are immediately entered into computerized systems that evaluate them against tax documentation, social security information, retirement distributions, and other banking information. The system isn't simply gathering information anymore. It's examining it in real time, and when it discovers something that doesn't correspond, that's when the difficulty starts. But there's another aspect to this, one that's even more risky than a basic large deposit. It's an error that well-intentioned people commit all the time, believing they're actually being clever. And in the perspective of the IRS, that single choice can transform a totally lawful transaction into a governmental infraction. That's what we're exploring next. Here's where everything transforms, and where many honest, law-following retirees unintentionally step into risky territory. Let's say you have $12,000 in currency. Maybe it's from selling a boat. Maybe it's savings you maintained at home. Maybe it's money you've had for years and simply never deposited. You enter the bank, and right before you approach to the window, a little thought in your mind says, if I deposit all of this at once, they'll document it. I don't want any additional scrutiny. So instead, you deposit $8,000 on Monday, then you return Wednesday and deposit the leftover $4,000. From your viewpoint, that seems innocent, responsible even. You're not concealing revenue, you're not evading taxes, you simply don't want documentation submitted with the government. That appears logical, right? But in the perspective of governmental regulation, that choice can totally transform the circumstance. This is something called structuring. Structuring occurs when someone deliberately divides a substantial cash transaction into smaller quantities for the intention of preventing that $10,000 documenting obligation. And here's the section that catches people unprepared. The money itself doesn't need to be unlawful. It doesn't matter if it originated from your retirement, the sale of individual property, or a contribution from family. If the deposits are divided particularly to prevent activating a currency transaction report, that behavior alone can be regarded a governmental infraction. And yes, fines for structuring can begin at $10,000 per infraction. Now let's differentiate this clearly because this is essential. If you enter the bank and deposit $12,000 in currency in one single transaction, the bank submits a CTR. That's it. Standard, lawful, no violation, no fine. In most situations, nothing additional occurs. But if you deliberately deposit $8,000 and then $4,000 particularly to prevent that document, you've just established a sequence that computerized systems are built to identify. And those systems are very effective at recognizing sequences. They examine at timing, they examine at quantities, they examine at progressions of transactions over days or weeks. If it appears like the deposits were organized to remain under the documenting limit, that's when warnings intensify rapidly. And here's the uncomfortable reality. The system doesn't interpret your thoughts. It doesn't understand you were simply attempting to prevent additional scrutiny. It only recognizes the sequence, and the sequence is what matters. This is where so many good individuals get into difficulty. They believe they're being careful. They believe they're remaining off some imaginary monitoring, but in actuality, dividing deposits to prevent documenting is precisely what positions them on the monitoring. Let me state this as clearly as achievable. Submitting a currency transaction report is not a difficulty. Attempting to prevent one can be, and this is the change occurring in 2026. With sophisticated computerization, cross-examining, and real-time evaluation, these sequences aren't slipping through the openings anymore. The system doesn't require a human examiner sitting at a workspace. It identifies discrepancies immediately. It links deposits to tax documentation. It evaluates documented revenue to currency behavior. And when something doesn't correspond, notifications go out automatically. Now, before you let this develop into worry, take a moment. The IRS is not focusing on retirees who are simply handling standard finances. The vast majority of individuals who deposit money correctly, even substantial quantities, never encounter an issue. The real risk is misinterpretation misinterpreting the regulation. So here's the first significant takeaway. Never divide a transaction simply to remain under $10,000. If you have more than $10,000 in legitimate currency, deposit it in one transaction. Let the bank submit the document. That's what the system anticipates. That's what maintains everything proper. If this is already helping explain things for you, take a quick moment to like the video and subscribe. I share information like this particularly to help retirees prevent costly errors before they occur, not after. Because now that you comprehend structuring, we need to discuss something equally as significant. How to safeguard yourself moving ahead. What basic practices can ensure that even in this fully computerized IRS setting, you're never caught struggling to justify your own money? That's precisely what we're addressing next. Now that you comprehend where the real danger is, let's change from understanding to safeguarding. Because this isn't about fear, it's about readiness. The application setting in 2026 may be more computerized, quicker, and less understanding of discrepancies, but the manner you safeguard yourself is surprisingly basic. It doesn't demand complicated legal approaches or costly shortcuts. It demands arrangement, precision, and a document trail. So here's the first step, and honestly, this is the most valuable one. Document everything. Whenever a substantial sum of money transfers in or out of your accounts, you want information that clearly justify where it originated from. If you sell your vehicle for $15,000, maintain a signed purchase agreement. Make a duplicate, digitize it, keep it somewhere protected. If your daughter provides you $20,000 to assist with healthcare bills, request her to compose a basic contribution statement indicating the quantity and that it's a contribution, not revenue or a debt. If you take a single sum retirement distribution, maintain the paperwork. If you remove currency for a substantial purchase, maintain invoices and receipts. The objective is basic. If anyone ever questions, you can immediately show the origin and intention of the money, because here's what most retirees don't understand. The IRS computer doesn't automatically understand the background of your transactions. It recognizes figures. Your paperwork supplies the narrative behind those figures. And when the narrative is evident and supported by documentation, issues tend to settle rapidly. Step 2. If your banking situation is more complicated than simply Social Security and a modest retirement, this is the year to meet with a qualified tax specialist. A good accountant doesn't simply submit documents. They help ensure your tax documentation presents a complete, consistent narrative. If you had a substantial deposit from selling assets, that needs to correspond with what's documented. If you obtained a considerable contribution, they can help guarantee everything is recorded correctly. Computerization identifies mismatches. A tax specialist helps avoid them before they occur. And step 3. Communicate transparently with your bank. This one amazes individuals. There's no problem in questioning your bank about their documenting procedures. Actually, openness works in your benefit. If you're intending to deposit a substantial quantity of legitimate currency, you can simply do it correctly and let them submit the obligated document. Remember, a currency transaction report is standard. It's not a charge. Attempting to prevent it is what establishes danger. When you combine these 3 practices, paperwork, specialist guidance when required, and openness, you significantly reduce your probability of ever encountering that $10,000 shock. Let's pause for a moment and position this into viewpoint. The computerized systems in 2026 are capable. Yes, they link information immediately. They cross-examine deposits with tax submissions. They recognize sequences humans might overlook, but they are still data-driven systems. They depend on consistency. When your information are arranged and your transactions are clear, you're functioning precisely the manner the system anticipates. This isn't about concealing, it's about precision. And if you know another retiree, perhaps a companion, a relative, someone in your neighborhood who still believes dividing deposits is a clever strategy, distribute this with them. A basic misinterpretation could cost someone $10,000 or more. Because the reality is, the banking world has transformed. The old manner of doing things where minor discrepancies might pass by undetected is disappearing quickly. We're now existing in a fully electronic application period. And the individuals who adjust early are the ones who prevent unnecessary worry. Which brings us to the larger perspective. Here's the larger perspective you need to comprehend. The application change we're observing in 2026 isn't temporary. It's not a trial initiative. It's not something that's disappearing next year. Computerization is now embedded into how banking supervision operates. The systems are quicker, they're more linked, and they're built to function continuously in the background. That means the retirees who are most at danger aren't the ones doing anything unlawful. It's the ones functioning under outdated beliefs. For years, many individuals believed that if something didn't immediately raise concerns at the bank, it probably wasn't a significant issue. If you maintained deposits modest, remained under the monitoring, or handled things quietly, you were being careful. But in today's setting, attempting to remain under the monitoring is precisely what establishes the monitoring signal. That's the contradiction. One clear $15,000 deposit with correct paperwork, standard, recorded, handled, disregarded, multiple smaller deposits made deliberately to prevent documenting, sequence identified, warning activated, questions created. The system isn't emotional. It doesn't presume wrongdoing, but it does presume that sequences meant to prevent documenting deserve examination. And when that examination starts, it can be demanding, time-requiring, and costly to settle. Now, I want to foundation this in confidence. Most retirees viewing this will never encounter a structuring fine. Most substantial deposits, when done correctly and supported by information, pass through the system without incident. The objective here isn't to make you nervous every time you enter a bank. The objective is to substitute uncertainty with precision, because precision transforms how you function. When you comprehend that a currency transaction report is standard, you stop worrying it. When you comprehend that structuring is about intention to prevent documenting, you stop unintentionally establishing risky sequences. When you comprehend that paperwork presents your banking narrative, you start maintaining the type of information that safeguard you automatically. This is really about perspective. The old perspective was maintain it quiet. The new perspective needs to be maintained it recorded. That single change can save you enormous worry. So here's the question I want you to seriously evaluate. If a fully electronic IRS system reviewed your last 12 months of banking behavior, would the narrative make logic on documentation? Would every substantial deposit have an evident justification? Would every transfer of money correspond with what's documented on your tax documentation? If the response is yes, you're functioning precisely where you need to be. If the response is I'm not certain, then now is the ideal time to arrange, to organize documentation correctly, to digitize paperwork, to meet with a tax specialist if required, and to organize anything that seems unclear. Not because you're in difficulty, but because readiness is far less costly than fines. You worked many years to accumulate your retirement savings. You gave up, you organized. You made careful choices so you could appreciate this chapter of life with protection and peace of mind. The final thing you want is the avoidable $10,000 fine because of a misinterpretation about how banking documenting operates. The regulations themselves haven't dramatically transformed. What's transformed is the pace, the observation, and the computerization behind application. And the retirees who succeed in this new setting aren't the ones who worry. They're the ones who adjust. So deposit substantial quantities correctly. Never divide transactions to prevent documenting. Keep paperwork for important banking occurrences. Ensure your tax documentation reflects your actuality. And regard openness as safeguarding, not revelation. Because when your banking document trail is evident, arranged, and consistent, computerized systems have nothing to question. And that's where peace of mind exists.